In general, as you look across the US, the aging of the population will probably have more wider spread impacts than most people perceive. And as I said, most of corporate America is not ready for this change.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Vikram Malhotra, Managing Director, Real Estate Equities and Research at Mizuho. Vikram is here to share some of the findings from recent Mizuho research into the economic and investment implications that are likely to emerge as a result of an aging U.S. population. Vikram, welcome to the podcast.
Thank you, Sarah, for having me. I'm excited to talk to you about our report.
Broadly speaking, how much attention would you say has traditionally been paid to the 75 plus cohort in terms of their spending power or consumer preferences?
It's an interesting question. So, there's been a lot of focus from several healthcare real estate companies, obviously, broadly hospitals and other folks in the call it life science and broader healthcare arena. But I would say most of the rest of corporate America in various other segments actually haven't paid a lot of attention to the so called boomers, frankly, more attention to the younger demographic. But I think the shift should occur now. It's important to pay attention because there's a big change occurring both in terms of just the absolute population growth, but more importantly, as we've done in this report, the spending power.
And can you talk a little bit more about how the outlook is now changing and what gives you the confidence to see that change happening?
For sure. So the US senior population, we define that as 75 plus, is set to grow at about 4% per annum over the next 5 to 10 years. That I think is well understood. What is not understood is how the spending patterns may change. So we've looked at using a variety of data sources, but primarily data from the BLS. They provide historical data on consumption spending by age cohort. And what I think is interesting, when you look at how the seniors' wallet share differs from the average US population, there are a few interesting things. One, for example, on rentership, there's a much higher percentage of their population. Second, on healthcare, somewhat obvious, but on insurance and medical services and devices, again, a big proportion. But thirdly, I think what's interesting is all the other categories. For example, on remodeling, we think there's going to be an uptick in spending as seniors look to remodel their homes. Potentially on food, there's less spending. Typically, seniors would consume less, and then so on and so forth. And we've done a deep dive looking at all the consumption buckets to see how spending will change. And I think when you marry the population growth with the spending, what we find is the senior consumer is going to become a much more relevant piece of the equation, growing at about 80% over the next 6 years, whereas the average US person the person in the US spending will probably grow at about 30 to 40%.
And as you mentioned, your research has looked into a range of sectors that could be impacted by an aging US population. But turning specifically to real estate, what are some of the top line trends that you're expecting?
So for seniors housing, I will say at the start, we have been very bullish. Seniors housing, Welltower has been our top pick. Last year, it's still our top pick this year. And with this analysis, what gave us more conviction and confidence is around the top line growth, or should I say the sustainability of that growth in seniors housing. As many may be aware, both Welltower and Ventas are exposed to the senior housing segment via their RIDEA structure, essentially getting direct exposure to the P&L. And with this analysis, we were able to get conviction around the top line growing pretty sustainably. So both the occupancy gains and the pricing power. From an occupancy standpoint, I think what's really interesting is you look at the caregiver ratios over the next 5 years, that is going to continue to trend down, which means the penetration, how many seniors are opting to move into seniors housing will go up. And that means there's a boost for occupancy. And then related to that is pricing power. And I think we'll sustainably see 5+% RevPOR growth. You combine those two things together, I think the operating income growth is sustainable at high teens, if not higher, over the next 3 years.
And looking a bit more at that growing need for retirement communities in the US, how would you say REITs are positioned to respond to that need?
I think both Welltower and Ventas are well positioned. They have somewhat differing strategies. Welltower, for example, has been acquiring properties in the senior housing space that are, call it, unstabilized, eventually in a year or two, rolling them into their same store pool. And as a result of that, seeing a pretty good impact or higher growth in their same store growth trends. Welltower has been buying more stabilized assets, closer to 90%. But I would say both have developed interesting tools in terms of capturing this demand, but B, making the economics a lot more efficient. And I'm happy to get into how they're making it a lot more efficient. But I would say, apart from these two REITs, there's probably a whole host of smaller players, including the operators, that probably need to step up and really improve their operations to take advantage of this over the next 5 years.
Are there other real estate sectors that are likely to feel the impact of an aging demographic?
Yeah, good question. So we allude to tangential impacts in this report, but certainly one can do deeper dives in all these aspects. I mentioned food consumption on the margin is likely lower. In particular, what one of my colleagues who covers the food space mentioned that in aging societies, things like poultry, other meats, seafood consumption tends to go down. Those tend to be big groups for storage and cold storage. And so on the margin, I think the operating environment for cold storage operators might get impacted. Secondarily, the housing market in general. If you assume a lot of seniors are going to sell their homes for raising equity to fund these senior living payments, there could be a lot of supply in certain markets. And perhaps from a demand perspective, it could take time for that demand to play out, particularly because the seniors selling homes are perhaps not what the younger demographic want. So theoretically, there's an oversupply situation coming, which can impact home prices. The office, I would say, you look at any surveys, it's very interesting. The senior demographic tends to A, use the office more, but B, tends to want more office space as opposed to open layouts. I think the aging demographic and retiring communities means that the overall working age population will be lower, and that perhaps means need for office space could be lower. I'd say there are a whole host of other categories, but these are three that we alluded to tangentially.
I just wanted to squeeze in an extra question about geographies. Are you seeing these patterns broadly consistent across the country or certain markets where it's more evident?
It's an important question. Certainly, there from a percent of the total population, there are certain states and markets where you typically see seniors tend to relocate to. Obviously, Florida is a key example. But I would say across the Sun Belt, we've certainly seen a fair amount of migration. What's probably more interesting is over the last 3 or 4 years, we've started to see other markets pop up. I would say in the Midwest or slightly moving towards the west part of the US, not California, but other markets, perhaps even in Utah, for example. So in general, yeah, I would say there's probably a more of an accentuated trend in certain Sunbelt markets. But in general, as you look across the US, the aging of the population will probably have more wider spread impacts than most people perceive. And as I said, most of corporate America is not ready for this change.
Your research also discusses the impact of an approaching wealth transfer from older to younger generations. What's the potential impact there in terms of real estate and real estate investing?
It's an important question. Looking at the US Federal Reserve data, seniors tend to own about 40% of all stock holdings. The second largest holding for them tends to be real estate, whether that's multifamily, office, or other investments. And I would say there's definitely a wealth transfer as you see more retiring. Those assets are likely to be transferred to the younger demographic or their children. On from a stock perspective, clearly one question is, as these assets are sold and the wealth transferred, do the younger demographic look at other stock options? Perhaps technology could be a beneficiary. From a real estate standpoint, the one obvious one is houses. As houses get transferred, I think there's a big remodeling opportunity, but as I mentioned, there's also a supply opportunity. The other interesting area could be both in secondary houses, but also in commercial. Certainly, the senior demographic that's sort of more wealthy does have a fair amount of holdings in the office side as well as in other commercial areas. And as that transfer happens, it'll be very interesting to see what the younger demographic does. Clearly, call it the millennium group or even the younger demographic is more interested in less ownership, more rentership, and then more technology investments, if I want to call it Bitcoin. So I think the broad effect could be a fair amount of supply hitting the market.
Vikram, we've covered lots of ground, but are there any other trends or developments that we haven't covered yet that pertain to REIT investment going forward?
I think one topic which is somewhat related to seniors, but one we're increasingly doing a lot of work with, which will have implications, is, Sunbelt has been a favored destination for seniors. And probably in the last 7 or 8 years, broadly, many people looking to migrate from California, parts of New York to the Sunbelt. The Sunbelt has clearly worked very well, both residential, commercial, industrial, in terms of pricing, fundamentals. And clearly, there have been a lot of corporate migration as well. The one trend we are starting to watch is how seniors, perhaps even other folks in other demographics, start to view what I'd say is the Rust Belt and probably the mid part of the US, whether it's climate change policy of the new administration looking to bring back manufacturing. I think you could start to see a bit of a shift away from the Sun Belt. But let me leave that there because that's a topic we're starting to do a lot more work in.
Okay, well, we'll have to come back to you on that topic later. Great. Vikram, thank you so much for spending time with us today on the podcast.
Very happy to do this, Sarah. And if there are any follow-up questions, please let me know. I'm happy to dig in.
Great. And to our listeners, if you enjoyed this episode, please leave a review or subscribe on your favorite podcast platform.